Hello and welcome to Money Matters. My name is Jim Butler with Forefront Advisors, and my co-host today is John Mason with Seeking Alpha. Welcome, John.
Thank you, Jim. Looking forward to talking with you.
We're going to have a good conversation today because our guest is, I think, very timely. The topics we'll touch on will certainly be pertinent to, I think, the vast majority of our listeners. And maybe to set the stage slightly, John, we can touch on some of the kind of the big picture or macro developments taking place in the economy and in the market. While we don't like to date ourselves as to when we're talking versus when the show will air. But certainly one of the big topics now is inflation. We know that's going to be with us for a while. And when that actually begins to rise or appear more is kind of a moving target. What are your current thoughts based on the outlook?
Well, this is a time of what some have called radical uncertainty. That in terms of the potential outcomes, we can't even list the potential outcomes at a time like this because there's so much happening and so many changes taking place. It looks like inflation is picking up. You look in the commodity markets, you look at lumber, you look at oil's picking up, you look at copper and things like that, and you really get an idea that prices are ready to take off. One of the questions that we get into, though, from this past recovery after the Great Recession is that we got a lot of movement in commodity prices, but we never got a lot of movement in consumer prices and things like that. So the real question, which I think Janet Yellen, for instance, Treasury Secretary, is dealing with, is that is this going to come out in consumer prices in terms of the things that really affect households and things like that? And that we're going to have to see, because the last couple times we've gone through something like that, we've got the inflation in asset prices, in housing prices, and other things like that, but we haven't got them in consumer prices. So we have this recovery following the Great Recession, and you find that the consumer prices on an annual basis only went up 2 to 2.5%, which everybody thought, wow, this is not like the modern America that we know.
Right. Well, when we talk to clients, we certainly hear comments regarding inflation and expectations all across the board, to modest increases to crazy increases. But I do think the reality is that if we just fast forward 12 months from now, inflation is going to take hold of consumer prices. I think we're going to see it as a result of all the money that's in the economy, both from the amount of savings people have accumulated because of what 2020 was like with everyone clamped down. Certainly the stimulus money that the government is sending out, as well as people starting to re-engage in the economy and simply generating more income with which to do something. So, one could easily argue in a general sense that prices are going up. The challenge will be for those smarter than us, like Janet Yellen, who has a little bit more control as to can they control inflation to a level that is more of a modest increase. Certainly that's going to play into it.
And one of the interesting arguments that I see coming out of some people from the administration is the fact that, yes, prices are going to go up, but it's only going to be for an intermediate time, and then they're going to back off.
Right.
Okay.
Right. Yeah.
Interesting viewpoint.
Yeah, sure. No question. And, with the economy re-engaging as a result of people getting back, somewhat to normal life, and hopefully that will continue, not only in the United States but abroad as well. And we can only hope that obviously the COVID situation continues to improve. But it has to do with domestic GDP as well as global GDP, because again, as people have money to spend, they're out there in the economy, they're returning to work, hopefully, and being involved. That's simply going to be further stimulus within the economy and allow GDP to be at the higher than average levels that we're experiencing.
And certainly the Federal Reserve has done its job. If you look at the reserve balances at commercial banks, which is kind of a proxy for excess reserves in the banking system, you've got way more than $3 trillion in excess reserves in the banking system. And one of the interesting things to me is that there was an article I believe it in the New York Times or the Wall Street Journal this morning about JP Morgan Chase and Citicorp. We're talking to corporations, asking them to take deposits and reduce their deposits because there's too many deposits in the banking system.
Right.
And goodness, over $3 trillion in excess reserves. I mean, where is it going to stay stagnant for an extended period of time? One just can't imagine what could happen if the lending demand started to pick up to any degree in the corporate world.
Right. Well, uncertainty is again first and foremost, and that plays into what the market's going to do, not only for the remainder of 2021 but into 2022 as well. So let's use that as our groundwork for the guest that we have. But before we bring him in, why don't we get to our question and use that as an opportunity to talk a little bit further. So Ed White from Philadelphia has written and asked, what are the advantages and disadvantages of buying Bitcoin? John, how could we answer his question?
Well, one way to answer it is what purpose is Bitcoin going to serve? That you can look at it in a couple different ways. I mean, we look at a currency, and Bitcoin is a cryptocurrency. If we look at it a currency, it can be a store of value, it can be a medium of exchange, and those seem to be the two major characteristics of it. And right now, Bitcoin is only seeming to serve as a store of value, and as a consequence, people trade on this store of value, and so one of the disadvantages. Well, one of the advantages is that it's digital. It is you can put your money there and keep it. You can make money on it. One of the disadvantages, though, is that it is extraordinarily volatile. Right. And the thing that gets me back to is that right now, Bitcoin's only a store of value. To have a real currency, you need a medium of exchange. And right now, Bitcoin is really not serving to any degree purpose of a medium of exchange, which I find some of the more interesting things going on taking place in terms of payment systems and things like that, that gets into the real medium of exchange. And you're having all sorts of technological advances that are taking place in the payment systems. Right. And what's happening to Verizon, and I'm sorry, what's happening to PayPal and Amazon Pay and Apple Pay and MasterCard and so forth. Very, very interesting things. What's happening in JP Morgan as far as payments, digital payment systems is just extraordinary in these days. And you move even farther than that, there's something called Sprint, which is a brand new company that was just valued at $95 billion. That is into a new payment system. It's in over 40 countries around the world, and dealing in many, many different currencies. There is so much that's happening here. And is Bitcoin just a store of value and doesn't really get into the medium of exchange business? Well, I think it's really missed most of what's going to be crucial as far as the digital world as we go forward over the next 3 to 5 years, as the banking systems, as the financial systems basically go digital. That's going to be what the difference is.
Right. Well, good answer. That's very thorough, and hopefully that provides some insight for Ed. Again, like we were talking before, we'll see with the digital currency and cryptocurrency. I agree, it's going to be volatile, and anyone who invests in it, I think they need to fasten their seatbelts and kind of get ready. So, but if you have a question you'd like us to answer, our panel to address, please write in, and here's the information to do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, today's guest is Joel Naroff of Naroff Economics, and we're in for a treat because I think all of us are going to get just a little bit smarter, hopefully, as a result of our conversation. So you're now challenged officially, Joel.
Thank you. I'll do my best.
So as a brief introduction, before we get into some questions for you, can you just give us a brief background, your brief background, so our listeners can understand that?
Okay, I've had really 3 careers in my life. I started off as an academic. I was a tenured professor at the Eisenberg School of Business at the University of Massachusetts in Amherst. I then went into banking in Philadelphia, where I was the chief economist of a number of the banks, First Fidelity, First Union, Commerce Bank, TD Bank, and now I'm strictly on my own with my own nice little economic consulting firm, Naroff Economics. So I've been an economist for a long time, but I've done it in a number of different forums.
Well, great. So that certainly allows you to touch on the topics that we want to get to today. And why don't we start with a part of what John and I had touched on, and that is the recovery that we're in. Some may argue it's not a recovery. Others would say, oh, yes, it is. What do you say?
Oh, we're clearly in a recovery. There's little doubt about that. And it's hard to see that this recovery is going to fail at this particular point. And I think the key thing, and it really goes towards the initial discussion you had, which centered on inflation, is this time different as far as economic growth is concerned? And if so, why is that the case? And we like to always say, oh, this time is different. The problem is this time it actually is different. Okay. And the reason is that we've never seen, first of all, a collapse as we had for such a short period of time. But much more importantly, and looking at the current and the future, economy as far as growth and inflation is concerned, we've never seen the government provide the kind of input, resources, funding across both the household and business sectors that we have at this particular point. And it's not over with yet. We've had over $5 trillion in funding and stimulus funds in an economy that's maybe $24 trillion. So we're taking a look at over 20% of the economy, having funding poured into it. And that makes it totally, completely different than past sets of circumstances. So when John said, for example, that in the past, commodity prices didn't lead necessarily to higher consumer prices, that was always the case. I mean, I constantly would say that the pathway from producer prices to consumer prices is hardly straight and rarely ends at the same point. But this point is different because what's driving a lot of the economic growth is the massive intervention into the economy of the government. And we know that that's going to happen at least through September. And if we take a look at what's potentially coming down the pike, that is the two massive programs on infrastructure and the family that President Biden is proposing at this particular point, we could see another $3 to $4 trillion put into the economy, not necessarily in a 12 to 15 month period, but in a 3 to 5 or 7 year period, and that will sustain the expansion. So when you ask the question, is this recovery real? It's real because the government is not going to let it fade. And that's critical. And that's also important as far as its implications for inflation, because if the government keeps pumping money in, we're not likely to have a significant slowdown unless that happens. And that's why, Jim, when you raise the question about 22, that's really the key question. What do we have in terms of the government's intervention in the economy, not this year, but next year? And that's going to determine growth and inflation and whether inflation is sustained.
Best you can tell from your experience, do you think the government has overreached because of the amount of stimulus and money they've put into the markets?
Well, I think, one of the big problems we have is that, because of the pandemic, which is a different cause than we've seen in other recessions, the both domestic and global supply chains have been greatly affected. And what's driving commodity prices now, and will likely drive consumer prices as we move through the rest of this year, is the problems we're having given the government's intervention and its stimulus and the problems of creating enough supply. What we see right now is because of the demand and the relative limited supply, businesses of all types, not just retail, but wholesale, have an element of pricing power they probably haven't had in 20 or even 30 years. Mm-hmm. And so you can say that's the case, but I think I understand where President Biden is coming from. If you go back to the Obama presidency after the Great Recession, we had a situation where the government essentially stopped putting money into the economy and indeed was restraining growth. And so we had about 6 or 7 years of subpar growth because of the restraint that the government had. It was actually having a negative impact on the economy. And I think what he's decided to do is he'd rather see too much than too little. And so that's where the error is being made. And I'm not sure it's necessarily bad. It depends on where we go from here. What happens in 22 and 23.
Right. Yeah.
May I jump in with a question here, Jim?
Sure.
Joel, it seems like too that there's also kind of a change in the philosophy of what's happening here. that in the past, both Republican and Democrat, it seems like a lot of the stimulus was basically we're pumping up aggregate demand, and that is going to make unemployment go down. Now it seems like a lot of what Biden is proposing in these two programs that he is developing are things that are more specific, that they're aimed at keeping business in America, aimed at improving the skills of the labor force, big emphasis on improving the opportunities for the middle class and things like that. So it seems like there's been a shift in policy rather than kind of the aggregate policy trying to lower things in general, which it's got referred to as a trickle-down type of policy, to one that's more specifically aimed at attacking specific weaknesses that people see going forward.
Well, I agree with you, but I define it in a slightly different way.
Sure.
I'm looking at the change as being a pivot from the short term. Let's pump up aggregate demand. Let's get the economy going. Let's support consumers and businesses through a very, very special set of circumstances. But once we get through September, let's start looking into the longer term and asking the question, how do we sustain this over an extended period of time? So if you look at his programs, yes, some of them are directed towards maintaining activity in the United States, but a lot of it has to do with a view that we need to start looking towards what the future is as far as, take energy is concerned. The issue of renewables versus carbon-based, to me, is the idea of thinking of energy as, moving from old energy, the carbon-based, into the new energy, which is all the renewables. You're looking at a productivity change. All of the elements of both education, childcare, middle class, college opportunities, even pre-K, is a longer term outlook that considers the issue of the economy in terms of the future and productivity. And that's what infrastructure is all about. The proposals are 8 years, and we know when something's 8 years, it's 10 to 12 at a minimum. But that's a long-term outlook, and all of those factors, to me, say, okay, we've done our job in the short term. Now let's see how we can sustain it by increasing productivity of both businesses through the infrastructure side and productivity of the workers through human capital side. And I think that is a huge change in philosophy as far as the government is concerned. And it's a complete change from what we've seen over the last 40 years. The whole Reagan low tax, limited spending philosophy is now replaced by the government involved in productivity of both the household and the business side through major expenditures.
Joel, do you see much?
Excuse me, just one comment. Joel, I think you said it very well, and I couldn't agree with you more that the difference between the perspective of short-term solutions versus longer-term efforts, I think you captured it very, very well, and I agree with you entirely.
Joel, do you see much risk on the employment situation? You're talking about the stimulus allowing people to increase their productivity, companies, private sector, public sector. There seems to be, at least in the short term, some challenges that some businesses are having finding workers because they are actually receiving government money in at least right now not returning to work, and they have an incentive, it would appear, to not do that. Do you see that as any degree of risk?
Well, I think there's no question that interference, and it is an interference in the labor market, is now coming to the forefront, because when we were looking at 8, 10, percent, 12% unemployment rates, there was a sufficient amount of labor and the slow opening of the economy that businesses, could find the workers. Now we have a situation where, especially in those lower paid sectors of the economy, people earn more through the enhanced unemployment programs. They make more by staying on unemployment than they would be if they get, not just minimum wage, but even $10 and sometimes $12 an hour. So that's putting pressures on it. It's also highlighting the fact that the minimum wage and the wage structure in this country is pretty low as far as what constitutes what is euphemistically called the living wage rather than the minimum wage. So yes, the government has created incentives through the enhanced unemployment payment system for people to stay on the unemployment rolls as long as possible. This runs out in September, so we're likely to see pressures for the next few months. But once that runs out, then people are going to have to be making decisions. That's why part of what's going on within the politics is do they extend that? And I'm guessing that won't happen, because now that we're below 6% and we're moving fairly rapidly towards 5% and less, we're getting into periods or levels where in normal circumstances labor shortages would be showing up. Now they're showing up even at a greater pace.
Can I jump in here again with another one? Because I think, again, what you started off here is a part of the whole fantastic increase in income wealth inequality over the last 60 years or so. To me, a lot of the short-run programs that we've been following for the last 60 years or so has exacerbated the income inequality, wealth inequality in the country. And I think if you look at the statistics for the last 18 months or something like that, even with the recession, even with the pandemic, there has been so much money available, and we've got these blank check companies. We've got the figures that have just come out in venture capital over the last week have just been incredible, of the money that is being made in the venture capital area. You look, I work a lot in angel finance and with young companies and things like that, and we talk about, whoa, all these people are suffering so, and things like that. There is just barrels and barrels of money available for angel finance right now and the like. So we've got this real bifurcation that has taken place that has exacerbated the income inequality, and that's going to come back, and somebody's going to have to deal with that sometime. What are your thoughts on that, Joel?
Well,
Joel, do you have a short answer for us?
Yes. My short answer is, Jim, I agree with you completely. And if you look at the issues, in the longer run issues, the two programs that the president has proposed, how is he going to fund that? He's going to fund that by basically, saying that those who have benefited so much over the last 60 years should pay now to kind of ease the issues that the lower income and even middle income households had faced, because the distribution of income has become so greatly skewed towards the upper income households. So I agree with you completely. That has to be faced, and it has to be faced sooner rather than later.
Yeah. Great. Joel, thank you. And thank you, John. Great conversation. I certainly feel more educated and have more nuggets to think about. So great conversation, and thank you for listening. Next week's guest is Maria Magicini, who's the CEO of Innovis Bio. So be sure to tune in for that show, and certainly many more. And have a great summer, and thank you for listening.